Welcome to Stocks in Translation, our essential conversation cutting through the market mayhem, the noisy numbers, and the hyperbole to give you the investment ideas you need for your portfolio. Now, I'm Jared Blickery, Sydney Freed here, as always, to my left, your right. And today we have Briana Samuels. She is a venture capital investor and owner of Good Rapport, New York. And we're going to get into this today because I think this is our first show on venture capital, on private equity. Yeah. We talk a lot about stocks on this show, but generally those are public stocks. So we're going to talk about the private capital markets. And this leads us to our phrase of the day, which is venture capital. We're going to break down what it means to invest in early stage and growth equity. And this episode brought to you by the number 1866. That was the year the Civil Rights Act was passed. We're going to discuss a key court case involving a nonprofit's right to give away grants. Briana, let's dive straight into what you do. You operate in the world of private equity offerings, the space that sees the action before the big IPO. So just tell us, what does that look like from your perspective?
Of course, and let's jump right into it. And first, thank you so much for having me today. So within venture capital, my focus has always been on the later stage side. So think Series B all the way through pre-IPO.
Could you just break down Series and tell us what that means?
Yeah, so some key series that you have are going to be your pre-seed rounds. Typically, this is just based on an idea. You haven't put together like a beta or a full product yet.
Do I have a napkin from a bar at that point?
Yes, okay. Pretty much that. Then
okay.
You'll transition into your seed rounds. The concept's there, you're starting to put the product together. Then you start to go into your series. And series can range depending on how much capital the company needs. You start at Series A, you can go all the way through Series D and beyond, and then it's
Uber
pre-IPO.
Went to you, I think.
Yeah.
I mean, so we've seen, and this is kind of a trend we've seen. You can blame this on the interest rate cycle. We'll talk about the Fed maybe a little bit later, but I mean, we've seen kind of big changes in the way companies come to market. And if we remember, like right around the pandemic, there were all these companies that we thought were going to come to market. Then we got a pandemic, that kind of threw things. But we had seen these companies just wait an ultra long time relative to history to come to market. And that we're talking Uber, that was a big one. You know, its competitor Lyft, but Uber was in existence for over a decade. Why have these companies just taken a lot longer to list and come to market?
Yeah, that's a great question and a great observation too. When we were in the pandemic, and specifically 2021 and early 2022, we were at the height of the venture capital market and growth equity market.
That was a peak.
Yes, so we were at the peak then, and this was driven by low interest rates and stimulus packages. So the investors had a lot of capital to deploy, and companies could easily access capital because there was a lot to go around. So instead of taking a little bit of uncertainty in pricing, it might make sense to stay private a little bit longer, raise additional capital, improve your financial metrics, and then come back into the market and then list on an exchange.
So what do you think would encourage more companies at this stage to go public to kind of boost that number?
How do we get those numbers back up?
Well, that's an interesting question because times have changed. So we have come down off of this peak and we're kind of in a steady state. So if you look at the recent data that we have, which is the first quarter of 2024, we've maintained a pretty defensive VC climate dating back to the second quarter of 2023.
That means companies aren't getting as much money. They're paying a higher price maybe. Tell us how this kind of trickles down and affects the companies' bottom lines, for instance, and how they compete and how they eventually compete to get to the market.
It's extremely tough and it's very competitive right now. Investors are focusing on how these companies align with their specific strategies and mandates. They're focusing on the technology and how strong and differentiated that technology is. And then lastly, they're focusing on the financial metrics and the bottom lines of these companies. How have they been able to perform efficiently and what is their capital efficiency like? And those are all the metrics that they're focusing on. And then those are the types of companies, if you're performing well in those categories, that get subsequent investment and then eventually will hit the IPO market. And if you are missing any of these, it is going to be extremely tough for you to raise money. And we're seeing a lot of companies being written down or even having to cease operations because they can't raise additional capital and they're not break even.
In terms of what kinds of companies are trying to go public or raise money, are we seeing just a mass amount of AI companies, or is it not yet? Is it all hype?
Is that not happening yet, maybe?
Maybe.
It's not necessarily happening yet, I would say, especially for this AI increase that we've seen. There's definitely been a huge amount of capital deployed to AI companies. In terms of the companies that are going to list, it's still a healthy amount, but it does come back to their financial profile. But there is an AI boom.
Let me ask you, I want to get to our phrase of the day. We've been talking about it. I don't want to dance around it anymore. Venture capital. Let's just get it out of the way. Venture capital is a form of private equity financing provided to startups and small businesses with high growth potential. It typically involves an investment in exchange for equity. It often includes managerial and technical expertise from investors. And so one of the things I'm reading in there, not only do you get money, you get some know-how as well, whether you like it or not. Like, tell us about that dynamic.
Yeah, it's a great dynamic, especially for startup founders. You're usually running pretty lean and efficient teams, and having the expertise of investors who have seen many startups and have had the ability to scale, they can provide advice in different components. Sometimes you'll prefer to get an investor with a certain type of industry expertise or even kind of consulting expertise, saying you have to bridge that gap from going early stage to late stage or late stage to then eventually IPOing. There are certain investors that have different specialties that you can tap into.
What happens if a company doesn't get the funding that they want?
Is it just bankruptcy?
Yeah, is it just game over?
So in terms of venture capital dollars, you won't go to bankruptcy just yet if you can't find the right investors
Well, if you don't
for
have
equity
assets,
funding.
nobody cares. I guess
Exactly.
that's one thing. Yeah.
Yes. So there is other funding that you can tap into, whether that is debt. And then based on your business model, there's additional types of financing. Say if you're like an e-commerce platform or you're providing some sort of product, you can then get loans and do revenue share agreements. But once you go to venture capital dollars, it is typical to continue raising venture capital dollars. And then the moment that you can't do it, if you can't get an asset-backed loan or any debt, unfortunately, you do go out of business.
I got to imagine that would kind of reflect poorly on not only the company, but also the VCs who made that initial investment. I know it differs situation by situation, but tell me the thinking that goes into how heavy a hand are we going to have in this business versus how laissez-faire is it going to be?
I'm so glad that you asked this question because I think a lot of people, when they think about venture capital and venture capital investing, you really think about that first part of the funnel of sourcing the investment and then doing the diligence to figure out if it fits your strategy and then writing the check. But there's also a very huge component to venture capital, which we call portfolio management. So you're going to build a good rapport with your management teams and have regular check-ins with them so that you can understand what's coming up in their strategy, if they have any pain points, so that you can get ahead of any of these challenges. And this is one of the reasons that I really love the venture capital market, is because it's also very collaborative. So you end up building a lot of relationships with the other investors and the other people that are on the company's cap table to figure out, okay, so we might see this challenge coming up. How can all of us rally together to help out this company and get past it?
We work at Yahoo Finance, where we've been taken over twice, at least in my lifetime here, going back to 2015. And when private equity comes in, I noticed that there are certain people who have worked together before and they're used to working together. And so you'll have these management teams that were successful before just kind of come into a different business and start all over. So it's been an interesting dynamic to see there. Wanted to ask you about misconceptions. I know you named a few in your notes, but what are some of the other misconceptions that we haven't talked about that people might have about private equity?
Yeah, so I would say that because we were in that peak where in 2021, early 2022, when it was so easy to raise venture capital dollars, the first thing I want to say is that you don't always have to go the venture capital route. Think about all of the other sources of financing, especially if you're early stage. So think about your angel investing network. So these are high net worth individuals that will come in, especially if you're a pre-seed company and you're an individual with a great idea. They can help you get that idea off the ground. You can also do things such as like crowdfunding, where there's amazing platforms nowadays to help you raise money money to then further your business, think about friends and family. We often call these insider rounds, and that has actually been very common in market over this last year. We've seen an uptick in the amount of insider rounds and friends and family rounds that have been happening, and then you start to go into a lot of the other channels that we discussed.
I like angel invest. I like the idea of angel investing.
You want to be an angel investor, don't you?
I want to be able to give that money to someone.
You just need $1 million.
I want to be a high net worth individual investing in other people's businesses.
It's $1 million, or the other component is if you don't have that in net worth, either $200,000 in annual salary for the past 2 years and expected for this current year, or if you have a significant other, that then gets bumped up between the two of you to $300,000 and same metrics.
Interesting.
So one of the things you're talking about here is the exemption for accredited investor, which we're just kind of getting to. There have been traditionally, I used to write private placements a long time ago, and they were more difficult to sell to investors back then because there were more regulations, there were higher net worth standards. Tell us how the game has changed, how these kinds of investments have been opened up to more regular folks. I'm not going to say the public because they're not public, but more people.
Yeah, the threshold has definitely become easier to access these types of investments. Also, the ability to get information on these types of startups has been more democratized. There's great platforms that give you whole databases of startups and even metrics. A great platform that I love to use is PitchBook. They have an amazing database. They often work with a lot of banks on research within the startup ecosystem, as well as giving you data on financial profiles. So there's a lot that the individual can access to determine, but venture capital is still very risky and you make a ton of bets. So you definitely have to be a person who is a little bit risk averse because you will be making several bets and not all of them will make it, but you do hope that a few do make it big and then that boosts your overall portfolio.
So you do need to be able to take on this additional risk. So it's not for everybody.
Exactly.
We need to take a short break, so hold that thought. But coming up, we are going to talk about a key First Amendment venture capital court case, as well as the latest in our Who Wore It Better series, emphasis series. Stay tuned. All right, this episode is brought to you by the number 1866. That was the year the Civil Rights Act was passed, and it prohibits racial discrimination in contracts. There's a court case today involving the right to grant awards targeted to minorities. And specifically, the American Alliance for Equal Rights, also called AAER, has sued the Fearless Foundation over grants that Fearless makes to Black, women-owned small businesses. The AAER suit alleges violation of the Civil Rights Act, and the Fearless Foundation is raising First Amendment freedom of speech issues. Tell us why this is important and then how people should be thinking about this case.
Yeah, this is a very important topic, and I'm glad that I can discuss it today. When you look at the overall venture ecosystem and who has been able to historically raise money and what the demographics look like, there has been a disproportionate allocation of capital. When you think about just women in general, they receive less than 2% of all VC funds raised from most recent metrics. When you look at people of color, that's about 1.6%.
That's even less than the 2%.
Exactly. And then when you look at women of color specifically, it's about 0.5 to 0.6%. And you look at the overall demographics of the country, there is a huge skew. So we do see this inequality. And there's several factors that lead to this disparity. Sometimes it's just the lack of representation, which we've discussed, but also in the seats of who's writing the checks and who's at these platforms. It's a pattern of...
Let's just stick there for a second. Yeah. So, there's a whole push to get the change, to get the boards of America, the corporate boards, looking like the general population. And this is just kind of illustrating why. If you have somebody who looks like you on the other side writing the check, well, guess what? They might understand a little bit more and have that. You were in the middle of a couple of different things here. So what else is on the table?
Yeah, so when it comes to your point too, even, I think it's helpful to arm you with the metrics that only about 2% of investment professionals are people of color. And then when you look at the people that are investment professionals that have that check writing capability, so at that partner level, that drops down to 1% of women of color. That's tying back to and very closely linked, as you can see, to the women founders of color who are getting capital. Some other metrics that are important and why we're seeing this disparity is pattern recognition. And you mentioned this, Jared. It's oftentimes we tend to spot patterns and trends and then repeat them.
Without thinking.
Exactly.
It's just human nature.
Like biases coming into play, yeah.
Yeah.
So how harmful is it to women and minorities if this decision stands?
Yeah, it can be extremely harmful because that will only decrease the ability to access that capital and make it that much more difficult.
So this is a court case. This is up to the judge.
Exactly.
But we want to raise awareness. What can people do? What can people do?
Yeah, that's a great question. So the Fearless Foundation, they have a petition going on right now. I highly encourage everyone to go to their website, sign the petition. We'll put it up.
Put it behind me.
You should also start this conversation. A lot of people should be talking to everyone within their network so that they understand what's happening and the implications, because it's not just going to end with this one specific demographic, because if the court does rule in the AAER favor, it's going to go after anyone who identifies as diverse, whether that is woman, LGBTQ+, or any other demographic.
We're talking about how it's been such a challenging environment for private equity overall, and we're talking specifically about how hard it's been for minorities and for women. Is it easier, do you think, to start a business today than it was 10 years ago as a woman or a minority?
I'm someone who always takes a more optimistic view.
Well,
so I think that even though we have these kind of challenges today, it's still a better environment if you are someone with a diverse background to start a company. You have so many different communities that you can join. There's so many more diverse investors, and then means to access that capital.
Well, and let me ask you, let's go back to where we were a bit ago. If you have an idea and all you have is an idea, where does someone start to figure out how they would actually open a business? What kind of, whether they're going the funding route or they have an angel investor or debt, I don't get how you even come up with at all how you're going to start.
Yeah, that's such a good question.
ChatGPT.
Yes,
Honestly, just ask the bots.
Yes, it's a good starting point, because then ChatGPT can quickly summarize for you kind of what is the state of play in terms of the business model.
About.
Exactly. And I always say a great place to start is research. Always do your research first. So if you come up with this idea, try to flush it out and break it down. Is this an idea that already exists? What problem are you trying to solve? And are you trying to solve it from a unique point of view? What do you need to then do to take this idea into actual reality? Those are all great places to start, but all rooted in research and market research specifically.
Love artificial intelligence. That's my starting point.
Yeah.
Especially for creative endeavors. All right. We are privileged today to have an actual fashion maven on deck.
And it's not me. Just pointing that out.
Yeah.
For today's Who Wore It Better? And the garb in question is the current funding environment for private equity. We're putting early stage companies looking for venture capital against some of their high growth cohorts who might have been around for a little bit longer. So it's the A round versus those later C rounds. And we want you, Briana, to tell us who is looking better in this environment.
Later stage companies are looking better in this environment. Exactly. And there's a couple reasons to this. So investors, because of this kind of wait and see mentality that they have, they are doubling down on their portfolio companies that are performing well. And oftentimes that means it's easier for an existing later stage idea to continue growing at a fast pace than an earlier stage idea that still needs to be proven out a little bit more. Also, later stage companies are closer to that idea of becoming an exit and a win for that portfolio, ultimately creating liquidity and continuing the cycle. And that's a big point that we're hoping to see more of in market is liquidity.
Well, let's define that real quickly, because liquidity can mean a lot of things in the capital markets. If you're trading a stock, you want the market to be liquid, but the liquidity that we're talking about is when that company first sells, that first sale on the public exchange where they sell 1 million shares for $1 million, and then that kind of sets the tone for the market. Tell us about the liquidity event there.
Yeah, so liquidity has still been slow and it's been a challenge. And a lot of research has gone into this, and a lot of investors have the mindset is that once we start to see the IPO market opening up, which is, as you were saying, Jared, a means for liquidity, but also think your M&A market.
Yeah.
Because then with a purchase and a sale, you can then return a lot of capital to your LP base. So we're trying and we're waiting to see those two things pick up, which a lot of research has said the first half of 2025, but that window keeps getting pushed back, as you know. We're waiting to see those things, but it's best to think about liquidity, especially in terms of venture capital, in the terms of IPOs, but then also M&A.
Tell us a little bit about your own career path since you've graduated.
Yeah. So I took a traditional finance route. Once I graduated from university, I was a major in both finance and entrepreneurship. And you can now see how my passions for both are coming together.
You've really played it there.
Yeah. Oh, yeah. It was something that I enjoyed all throughout university, but I started on Wall Street as an investment banker. I started covering financial institutions, so working in verticals such as banks, asset managers, insurance companies, and even private equity, which was a great window into what I then did in the next chapter of my career, which was late stage venture capital and growth equity investing.
All right. But you've also started your own fashion line here, so to speak. Tell us about that venture.
I did. So in December, my brand, Good Report New York, launched. We create modern, sustainable workwear for women. We manufacture in small quantities here in the Garment District in New York City.
So you're very local.
Oh, yes.
All right.
And that is one of our main sustainability efforts because at this day and age, that's where our consumer is and we're closest to our consumer. But not just are we selling product, we really want to build a community of women and allies. And we want to, through fashion, empower women to be agents of change, beacons of light, so that they can then empower others that are in their networks.
Hey, I've been on your website. I'm looking at some of those blazers there and the skirts. My question for you is, what was the hardest part about creating your own brand, your own company, considering that's kind of what you do for your work?
Yeah,
and you said the environment has not been the most favorable for these early companies, but yet here you are, you're trudging on.
That's true. I would say, to answer your point first, is that I fully bootstrapped my company. So I haven't had to
worry about the
exactly. I haven't had to worry.
Wait, can you define? Did you say bootstrapped?
Yes. So
can you define that for our crowd?
100%. So bootstrapping is when the founder or that founding team uses all of their own personal capital to start the business, and they're not taking any outside investment. Ownership is concentrated to that one person or that 2 to 3 individuals on that founding team.
Can I ask you what your thinking is toward maybe a liquidity event in the future? Because I would assume lots of people, you're talking venture capital or early seed stage, most people would have the goal, I want to voice this, I want to sell this company to retail someday. Mm-hmm. Is this something you want to hold on to though? Do you want to keep it small? Do you want to keep it private, or do you want to get really, really big?
Yeah, that's a great question. I want to keep it for the long term. I don't have the viewpoint in venture, which is typically to hold your investment for 5 to 7 years and then seek an exit. I want to hold mine into perpetuity. I truly want to build a strong foundation, and I'm all about slow growth and thoughtful growth, which means that there can't be a timeline put onto that. I think in the last 10 years, we've seen that it's pretty common for people to hold their startups for that 5 to 7 year window, just because you put in such a significant amount of time and money, and you want to see that exit and maybe close that chapter of your life and start something else. You see a lot of serial founders who build a company and then exit, and then they start something else again, especially with that capital that they were able to get from the sale of their business. I think it all depends on the individual and the person. If you have a very strong vision, a very unique vision, and you want to do this for the rest of your career, it's probably best to not seek that sale. But if you are someone who's very multifaceted, have multiple interests, and want to do multiple things and start multiple companies, it may make sense to only hold it for a short period of time.
Briana, we have to leave it there, but if I ever venture out on my own, I'm definitely consulting with you. Thank you for just dropping by here today. Sydney, as always, and we got to leave it there, so stay tuned. Keep it locked to Yahoo Finance.